Hello, welcome to Module 17, which is on transfer pricing. Let's take a company such as General Motors, or if you want to be real cynical, Government Motors as it's now known. Let's take two divisions within General Motors, such as Chevrolet and Buick. Could Chevrolet sell engines to Buick? Of course. In this situation, the selling price is called transfer price. So, let me repeat. Within one organization, when one division sells parts to another division, the price they set is not called selling price, it's called transfer price. So, we're talking about transfer pricing. Assume the manager of Chevrolet gets greedy and increases his or her transfer price to Buick. What would happen to his or her ROI, return on investment? Yeah, you got it. It'll increase. So the Chevrolet manager looks really good. Conversely, what will happen to the return on investment of the Buick division manager? Oops, it'll decrease. Will the manager of the Buick division be happy? Absolutely not. Managers are promoted using ROI or ROA as the performance measure. So the manager, he or she, will not take it lying down. What do you think the manager would do when they see their ROI drop? Let's see. The manager of the Buick division could say, to hell with you, I'm going to buy motors from the rival company Ford. Now, his or her ROI will increase. So in the short term, it's good for the manager. But in the long term, is that good for GM? No. This results in GM losing cash to a rival company, Ford. Cash, which could have stayed within GM, has now gone to a rival company, Ford Motor Company. What else could the manager of Buick do? They could focus on the customer. They could tell the customer, we're going to increase selling price. That also is bad for GM. In the short term, it's good for the manager of the division. In the long term, however, it's bad for GM because GM will lose market share. So you can see that an inappropriate transfer price will have adverse consequences for GM. This is why transfer pricing is really important. So, let's consider the objectives of transfer pricing. The objective of transfer pricing is to set a price where managers of both divisions are satisfied, company output increases, company profit increases. Sounds easy, right? Actually, it's quite a challenge. Let's talk first about the different transfer pricing techniques. Transfer price could be the transferring division's variable cost. It could be actual full cost, which is the variable cost and the fixed cost. It could be the actual full cost plus a profit margin. It could be another technique called budgeted cost plus profit margin. Or it could be a market price. There are others too. I just gave you a couple. Now, let's talk once more about the motives and importance of transfer pricing. This is important, so I'm going to reiterate. The objectives of transfer pricing. 1. When the boss sets a transfer price, the transfer price should be seen as fair and equitable by both divisions, the selling and receiving divisions. The transfer price should provide an incentive to increase company profit. The transfer price should provide an incentive to increase overall company output. The best way to understand transfer pricing, rather than me just talk and talk, is to illustrate the concepts with problems. So here we go. Here is the first problem from this module. I just want you to take a few minutes and read it. Problem 1. The parts division of an organization sells parts to the assembly division of the same company. The cost of making parts is $10 a unit. At a cost of $4 per unit, the assembly division assembles the parts purchased from the parts division and then sells this assembled product to customers for $23 a unit. Okay, here is the problem. What I'd like you to do is print this out. You're going to get a couple of questions based on this problem, and hopefully you'll see the advantages and disadvantages of different transfer pricing techniques. So here's the first question. What's the profit per unit of the two divisions if the part division's cost of $10 per unit was used as the transfer price between the part and the assembly division? Please stop this presentation and try the problem. Once you're done, I'll give you the solution. So stop the presentation for a few minutes. Are you done? Let's have a look. In the top part, I'm repeating the question which you already have. Okay, let's see how it works. If it's transferred at cost, and the cost is $10, so the transfer price is the cost, which is 10. So for the parts division, the profit will be 0. Let's go over and look at the assembly division. The revenue is 23. The costs are $10, which is what they paid the parts division, and $4, which they incur to assemble the product. Revenue is 23. The costs total $14, so the final profit is $9. Think about it. Do you see any problems with this technique? Well, obviously, the main problem is that the manager of the parts division will be very disgruntled as the parts division is not recording any profit at all. So, what's the solution? The solution is set a technique or transfer price that generates a profit to the parts division. Okay, let's see how that works. Here is the next question. I'd like you to take a few minutes and try it. So, do me a favor. Stop this presentation, print this out, take a few minutes, and try this problem. When you are done, we'll restart. In this problem, we're making sure that the parts division makes a profit. So the transfer price is the guy's cost plus a 20% profit margin. Okay, have a go. Okay, here's the solution. I repeated the question at the top. So let's go. The transfer price would be 12 because it's a cost of 10 plus a 20% profit margin. Okay, so the transfer price is 12. The cost is 10. So the profit is $2. On the other side, for the assembly, the revenue is 23. They pay $12 to the parts, and there's an assembly cost of $4. So the total cost is 16. The revenue is 23, so the profit is $7. What's the company profit? It's the part division profit of 2 plus the assembly division profit of 7. So the company profit is 9. What was it before? Still 9. So the company profit has not changed, but it's distributed more equitably between the parts and the assembly divisions. So, what do you think? Do you think that this is better? Do you see any problems with this technique? Okay, there are two ways I could do it. I could explain the problems, or I could work another problem and illustrate the concept. So in order to understand the problems with this technique, please view the next question. Here's part D. Please read it, stop this presentation, try this, and then restart. In this situation, they use the same transfer price, cost plus 20% profit margin. Here though, they are inefficient and the cost increases to $14 per unit. So the question is, what's the profit per unit of the two divisions? So stop and restart when you're done. Are you done? Here's the solution. I repeated the question at the top part. Okay, let's go down. Look at the solution. The transfer price for the parts division is the cost, which is 14, plus a 20% profit margin. So it'll be 1680. The cost is $14. The price is 1680. So the profit for the parts division is $2.80. Let's go across. For the assembly division, the revenue is 23, and the costs are the cost of buying from the parts division, which is 1680, plus the assembly, which is 4. So their profit is $2.20. What's the company profit? The company profit is $5 a unit, so it's gone down. The company profit has gone down. But here's the interesting situation. The guy who messed up is the parts division manager. They messed up, but they're showing a higher profit, 280, relative to what they had before, which was 2. Isn't this a ridiculous situation? The division who messed up has shown increased profit. They actually transferred their inefficiency to the next division. So the assembly division looks bad due to no fault of their own. So let me reiterate. Here are the problems with using cost plus profit margin technique. Number 1, inefficiency of one department doesn't stay with that department, rather it's transferred down to other divisions. 2, the division that's inefficient, that messed up, appears to be the most profitable. That's the irony of this. Number 3, when company profit declines, for you as the boss, it's difficult, let me repeat, difficult to pinpoint responsibility, because the guy who messed up actually looks good, because they transferred their inefficiency down. So what's the solution? How about instead of using actual cost, use a budgeted cost plus profit margin technique? Do you think that'll work? Let's see. Okay, so here's another part. I'd like you to try part E based on the same problem. Take a few minutes, read it, stop this presentation, and try it. When you're done, restart. Are you done? Here's the solution. The profit for the parts division is 2. The profit for the assembly is 7. And the company profit, if you add them both up, is 9. Looks good so far, right? Here's where it gets messy. Problem 1, part F. Try this. Stop the presentation for a minute. Try this. And when you're done, start it again. It's the same problem. You're using budgeted cost plus 20% profit margin. The only problem is the cost has increased to 14 per unit because they've been inefficient. In this scenario, what's the profit of the two divisions? Okay, are you done? Here's the answer. I repeated the question at the top. Here's the solution. The revenue is an agreed price of $12, which is the budgeted cost of 10 plus 20% profit margin. That does not change. That's the agreed transfer price. What happened here? The parts division has been inefficient. They incurred costs of 14. The revenue is 12. The transfer price is 12. The cost is 14. So they have to report a loss of 2. Look across at the assembly division. The revenue is 23 and the costs are 16. They buy it from parts at 12 and incur assembly of 4. So the total cost is 16 and they make a profit of 7. So the profit of the assembly division does not change. However, what's the company profit? -2 plus 7. So the company profit has gone down to $5. You're the boss. Can you pinpoint responsibility? Sure. It's the parts division which has reported a loss due to their inefficiency. Has the assembly division been penalized because the parts division messed up? No. So what do you think? Is this a good technique? Let's start with the advantages. If company profit declines, it's easy to pinpoint responsibility to the department that's responsible for the problem. So you as the boss know who messed up. Is that good? Sure. Any inefficiency is not transferred to other divisions. It stays with the guy who messed up. Is that good? Sure. Okay. Now, in transfer pricing, there's no perfect solution. So, this is important. Do you see any problems, any disadvantages with this technique? Why don't you think about it? Stop this presentation and just think about it. Are there any problems with this technique, or is everything hunky-dory? Okay, here are the disadvantages. The budgeted cost is estimated. The unions would want this cost to be as high as possible. Management would want this budgeted cost to be as low as possible. Hence, the use of this technique could result in confrontation between management and unions. If unions perceive the budgeted cost as too low, they'll be aggravated and there will be confrontation. So, how can we overcome the problems associated with this technique? What do you think? Here's the question again. How can we overcome the problems associated with the budgeted cost plus profit technique? Any ideas? We need a technique that avoids confrontation. The best technique is market price. So let's see how the market price works. Here's the next part, part G. Assume the company decides to use market price as the transfer price. They find that the market price is $14 per unit. What's the profit per unit of the two divisions if the PATS division incurred costs of $10 per unit? I want you to stop this presentation, try this, and when you're good and ready, we'll restart. Okay, you're done it? Here's the solution. The parts division generates a revenue of 14 because that's the market price and it's sold at market price. The cost is $10, so their profit is 4. Let's look across to the assembly division. The revenue is 23. The costs include the cost of buying from the parts division, which is 14, plus the cost of assembly, which is 4. So the profit is 23 revenue minus 18 cost, which is 5. What's the company profit? It's a profit of the parts plus assembly division, which is 9. So the company profit is 9, and you can see it's equitably distributed. So both divisional managers should be satisfied. So is this a good technique? What do you think? Okay, let's do one more problem, one more part before I give you the answer. Assume the same case as before. The company decides to use the market price of $14 per unit. What's the profit of the two divisions if the parts division was inefficient and incurred costs of $14 per unit? Stop this presentation, try it, and restart when you're done. Okay, here's this. I guess you're done. Here's the answer. Parts division makes, they've been inefficient. The cost went up, so their profit is 0. The company profit is 5, which is 0 plus 5. So the parts division has been inefficient. Their profit is 0. The assembly division's profit is the same as before. So the assembly division has not been penalized. The parts division, which has been inefficient, has been penalized. So using this technique of market price, can you pinpoint responsibility for poor company performance? Sure you can. You can see it right in front of you. Who messed up? The parts division. So what do you think of market price? Let's discuss the advantages of using market price. The advantages are: the price is not contentious and will not create friction, because you don't have to negotiate. It's the price which is out there in the market. The price is objective. Using, for example, the previous technique of budgeted cost, it's estimated, so it's subjective. Here, the price is objective. It's what's out there. The price results in equitable distribution of profits. So does this technique look good? Does using market price have any disadvantages? Think about it. Unfortunately, it does. First, not all items have a market price. For example, unfinished products. If an unfinished product is transferred, does it have a market price? No. So you can't use it. Here's a bigger problem. Out there, if the market price declines, the profit of the transferring division will decline. So they start looking bad. This is not the transferring division's fault. It's beyond their control. So if the market price declines, the transferring division looks bad and they'll be unhappy because it's beyond their control. The only thing I figure you learned so far is that there's no perfect technique. So, what have we learned so far? We learned the different types of transfer prices that are used by companies. We learned the advantages and disadvantages of each. Let's move on. I want to discuss another vital issue regarding transfer pricing, but I'd like to use a problem to illustrate the concept. Here's the problem. The restaurant division of a hotel provides a catering service for the hotel's convention center. It charges outside organizations $19 per person for catering. The catering services comprise a plate of hot food, starters, and wine. The convention division of the hotel can buy the same catering services for which the going market rate is $21 per person. You are the boss of the hotel, which comprises the restaurant and the convention center. So put yourself in the position of the boss. Here's what's required. What transfer price should be used between the restaurant division and the convention center to encourage decentralized decision making that will maximize profit for the hotel? Key word is hotel. Assume you have a choice between 18, 19, 20, 21, and $22. I'd like you to have a crack at this. Stop this presentation and think about it before moving on. Okay. Let's start with $18. Do me a favor. Draw a diagram. Write restaurant, draw an arrow, and write convention center, like I did at the top of this slide. Can you see the question mark between the restaurant and the convention center? That is where I want you to put the price. Okay. So let's start with $18. Replace the question mark with $18. If you requested that the restaurant sell to the convention center at $18, first, would the restaurant manager be satisfied? No. By selling outside, they get a revenue of $19. If they are forced to sell to the convention center at $18, they are losing money. so they would object. That's why I put no in the box for $18 under the restaurant. Can you see it? Would the convention center be okay with this transfer price? They buy from outside at $21. Under your scheme, they can buy from the restaurant at $19. So they actually save money. So of course they would like it, they'd accept. That's why I put a yes in the box for the convention center for a transfer price of $18. At $18, the restaurant says no, the convention center says yes. Okay. Now, I want you to put a transfer price of $19 where you see the question mark. So stick in 19. Start again. Would the restaurant be okay? To be honest, they wouldn't care. If they sell outside, they get 19 as well, right? So whether they sell outside, they get 19. If they sell to the convention center, same price. So they wouldn't care. That's why I put the word indifferent in the box. They don't care. But they won't object. They won't object. They don't care. What about the convention center? If they bought outside, they would have had to pay 21. Under your scheme, they only pay 19 to the restaurant. That's cheaper. So they would say, yeah. Okay, let's go to 20. Put in $20 to replace the question mark. So put $20 in the place of the question mark. Let's try again. Would the restaurant agree? Sure. If they sell outside, they get 19. Here they get more money, so they'd agree. They'd say yes. What about the convention center? Hey, they would agree too. If they buy out, it costs them 21. Under your scheme, they get to buy from the restaurant at 20. So it's still cheaper. That's why I put yes and yes in the box, as you can see. Let's go to 21. Put $21 under the question mark. Does this work? The restaurant would agree and the convention center would be indifferent. The restaurant agrees because they make money. The convention center would be indifferent because they can buy it out from outside at the same price. So they won't object. They'll be just indifferent. I don't care. Okay, let's try 22. Under 22, the restaurant would agree, but the convention center would object because they can buy cheaper outside for 21. They certainly would not like to pay a higher price to the restaurant. So here you get one manager, restaurant manager saying yeah, and the convention center manager disagreeing. So we have a yes and a no. You don't want to set a price where one department objects and is miserable. So where do you see the no's? 18, you see the restaurant manager objecting. Rule that out. 22, you see the convention center manager objecting. Rule that out. So what do we have? Now you have your range of prices that could work. The prices are 19, 20, and 21. Which is better? This is going to be a challenge. I'd like you to stop the presentation, think about it, and restart when you're done. Here's the answer. Did you get it? The answer is actually 19. Why? When a series of transfer prices could work, if you want to maximize profit for the company, always go with the lowest. It's been mathematically proved. If a series of prices could work, go with the lowest possible transfer price that can work. That will result in an increased profit for the company as a whole. So you learned something else now. Let's discuss more concepts. Once again, I'm going to give you a problem and teach you additional concepts using the problem. Here's your third problem. Carly Company has two divisions. Each year, the paper division makes 10,000 tons of paper that cost this division $1,000 per ton. You can either sell all of the paper in the market for $1,500 per ton, or transfer all of it to Carly's printing division, which converts it into gift wrap at an additional cost of $4,000 per ton. The gift wrap can be sold for $5,200 per ton. What I'd like you to do is to print this slide out. Okay, based on this, here's question 1. What's the company's profit if the paper is transferred to the printing division? Assume the transfer price is at cost. Is this transfer price beneficial to the company? Stop this presentation and try this problem. When you are done, restart the presentation. Okay, here's the solution. You're transferring it at cost. The cost is 10 million. The revenue for the paper division is 10 mil because you're transferring at cost. So their profit is 0. Go across. The revenue is 52 mil. The cost of buying from the paper is 10 mil, right? Revenue to the paper division is a cost to the printing division, and they incur additional cost of 40 million. So their profit is 2 million. What's the company profit? If you add them up, 0 plus 2. So the company profit is 2 million. Okay, here's the next question. What's the company's profit if the paper is transferred to the printing division, but the transfer price is at current market price? Would the paper division approve this, and would it be beneficial to the company? Once again, stop this presentation, try the problem, and restart when you're done. Okay, here's the solution. You're transferring at $1,500 per ton. So the revenue for the paper division is 15 mil. Their cost is 10 million. They make a profit of 5 million. Go across to the printing division. Their revenue is 52 million. The costs, they pay 15 million to the paper division, and incremental costs are 40 million. Their costs are 55 million. The revenue is 52 million. So they make a loss of 3 million. Has the company profit changed? No. It's still 2 million, because 5 million less loss of 3 million gives you 2 million, which is the profit as before. So I'm going to ask you a question. What you saw, does the market price work? Or do you think the cost works, transferring a cost? If you don't like either of them, here's the question. Can you suggest any other strategy that would maximize profit for the company? What are the costs of this strategy, if any? So you have a choice now. You can stay with cost. If you do that, the first division would be unhappy. You could do market price, right? But the other guy would be unhappy. Or you can be creative and come up with your own strategy. What would you do? Okay, here's the solution. The objective is to maximize profit for the company. Kali company could decide to discontinue the printing division. If they do, and the entire printing division is gone, the profit of the company would be 5 million instead of 2 million. That's what they're doing right now in industry. It's now referred to as downsizing, or they even call it right sizing. But the net result is that divisions are closed down to maximize profit for the company. If you ever wondered why do divisions close down, you got the answer in front of you. What are the costs? The costs are the golden handshakes that have to be paid to the employees, because you got to pay them something and let them go. But overall, unfortunately, companies do this strategy because this strategy gives them the most profit. Okay, the final topic is international transfer pricing. The objective of international transfer pricing is to reduce tax liability. That's it. One objective only, reduce the tax bill. Now here's a question for you. Assume you're an international manager of a corporation with the main company in a high tax country and a subsidiary in a low tax country. I think I used the word company, it should be country. So the main company is in a high tax country and the subsidiary is in a low tax country. If the objective is to reduce the tax bill, should the transfer price be set high or low? Why don't you have a crack at it? Stop this and think about it. And then when you think you have an answer, restart. I'm not going to tell you the answer. What I'd like to do is to do a problem. I'll illustrate the concept vis-a-vis this problem. I think the best strategy is for you to print the problem in front of you out. And I'd like you to take 10 or 15 minutes reading this problem. Pepsi Company ships 5,000 units of syrup from the United States to a foreign country subsidiary that adds carbonated water and then sells it. So you're transferring from US to a foreign country. The US income tax is 40% and the foreign country's tax rate is 20%. The cost to manufacture and ship the syrup is $14 per unit. It costs the foreign subsidiary $10 per unit to add the water, the can, and then they sell the drink for $80 per unit. The table, which I'm going to put up now, summarizes the tax rates, final sales price, operating cost, and units transferred. So have a look at this table, which is going to come up now. Okay, I'd like you to print this table too. I have two questions for you. If PepsiCo can select a unit transfer price of either 16 or 18, and the objective is to minimize its total tax bill in both countries, what transfer price should it select? And the second question, how do countries prevent multinational corporations from reducing tax liability via transfer pricing schemes? So let's do it one at a time. I'd like you to stop this presentation and figure out the tax when the transfer price is 16 and the tax for PepsiCo when the transfer price is at 18. Try it and then restart when you're done. Okay, does this correspond to your answer? Here's the solution for the $16 transfer price. The USA sells 5,000 tons at $16, so their revenue is $80,000. It costs them $14 per ton, so the costs are $70,000. The profit is 10. The tax rate is 40%. So the tax paid is $4,000. Let's cross over. In the foreign country, the sales are $5,000 at $80, so they generate revenue of $400,000. What are the costs? The cost of buying from USA, that was $80,000. They also incur incremental costs of $10 per unit for the 5,000 tons. That's $50,000. So the total cost are $130,000. The profit is $270,000. The tax at the rate of 20% gives you a tax liability of $54,000. So the combined tax bill is $58,000, $4,000 in US, $54,000 in the foreign country. So when the transfer price is $16, the combined tax is $58,000. Now I'm going to give you the solution for the transfer price at 18. Here it comes. Did you notice the change? I changed the numbers. The transfer price is at 18. So the revenue for USA is $90,000. The costs are the same as before. So the profit is $20,000 and the tax at 40% gives you a tax bill of $8,000 in the US. Go across to the foreign country. The only thing that changes is the cost of buying from USA. Now it's $90,000. Everything else is the same as before. So if you look, the total costs are $140 and the profit is $260,000. The tax, therefore, at 20% is $52,000. The total combined profit is $60,000. So, did you get it? When you are transferring from a high tax to a low tax country, if you want to reduce your tax bill, keep the transfer price as low as you can, and vice versa. So, we're talking here international transfer pricing. For international transfer pricing, the objective is to reduce the tax bill. When transferring from a high tax to a low tax country, keep the transfer price as low as possible. When transferring from a low tax to a high tax country, keep the transfer prices as high as possible. And that's what companies do. The governments respond by saying, hey, we don't agree with your transfer price. Use a technique called arm's length pricing, which is, if you're not selling to your own company abroad, but selling to a real customer, what transfer price would you have used? So that's called arm's length pricing. And countries try to prevent themselves from getting cheated by requiring transferring companies to use what's called arm's length pricing. But that's a whole different issue. And there's a lot of things going on regarding that.